Today we had a wild intraday swing as the FOMC minutes came out and talked about the risk of recession later this year. Is this bad news for the stock market? First up, let's take a look at the S&P 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright. So today we had no lack of excitement with the CPI data coming out this morning, and we did get that beautiful gap up above resistance at 411 and then gave it all the way back by the end of the day, finishing with a bearish engulfing candle. So anytime you get a bearish engulfing candle like this, you instantly need to respect the fact that price action just had a sharp rejection from a critical resistance level. Now, just a quick announcement: if you are trading options and you are not profitable and you are still trading options, do not forget the definition of insanity is doing the same exact thing expecting a different result. There's so much hype around options trading, but you have to ask yourself, is it actually a profitable venture? And if it's not, you need to turn away from it and start trading shares. If that message helped at least one of you, then it was worth it. So let's quickly talk about the FOMC minutes, because they did drop a bomb during the meeting and they were talking about the risk of a recession later this year. Do not for 1 second think that the market was not already aware of the risk of recession later this year. This is no new news for the market. There is not a single big money player in this stock market who has not considered the probability of a recession later this year. So it is absolutely going to be a nothing burger. We are still going to be following price action only. So if you opened up a ton of short positions today because you think there's a recession coming, you are going to get absolutely destroyed by the market. Your trade plan should not depend on a single word the Fed says, because they have absolutely no credibility, and this is the same Fed that told us inflation was transitory. So what I'm trying to tell you is that everything on the chart that is already priced in is going to show in the price action. We are going to strictly follow price action and not speculate on where the market should be, because we have a chart of the market and we can see where the market is currently going. So if the market is going to get bearish, we need to lose this support zone at 407. And on the hourly chart, that's actually closer to about 406. You can see by these wicks that we actually have gone and found lower support levels. And if we break that support, this is going to look like a double top rejection from 411, which is obviously a bearish pattern that sends us to lower prices and at least to fill the gap down here below 402. That's also where we have our support trend line, so we are looking for the possibility that that could occur. The price action trigger will be the breakdown below this support zone, so you have very well-defined risk at that support, and you know exactly what support has to fail to tell us we're going lower. There is no guessing about it. It's 100% objective, and it lets the price action do all the talking. Now, with that being said, if you start shorting at support and we bounce from 407 and then go straight up to the resistance at 414, you're going to have a very difficult time managing risk on that position, because the risk level is all the way up here at 411. So be very disciplined with your risk management and make sure you're taking trades based on the risk reward setup and not some emotional reaction to any news or any current price action. We did not lose any critical support today, and we did have a very clear rejection from resistance. So you're instantly getting more defensive because we just had a sharp reversal, but we have no confirmation until we break the support below. And yes, that could happen as soon as tomorrow. And then you could start shorting the market using that breakdown as your risk level. If you are not managing your risk because you're entering in between support and resistance, you're simply just going to get whipsawed, and you're going to have an absolutely terrible time trading in the market because you don't have any well-defined risk. So right now with this bull trend, and yes, this is still a bull trend because we now have this 20 simple moving average crossing back over the 50 EMA, the bulls will be looking for support levels around SPY 407, 404, and just below this gap fill, just below 402. That is 3 very well-defined support levels that currently define this bull trend, and if we break down below those, that's obviously bearish. It means we're likely going lower, and if we're going lower, we're likely going down to fill the gap at 396 and retest the 200 daily moving average at 394. So make sure your trade plan is prepared for the bearish scenario and the bullish scenario, and the bullish scenario would be a bounce from support, breaking 411 and going to test upper resistance at 414 and just below 417. Both of these scenarios are perfectly viable scenarios, and the current direction of the trend is still higher. Again, the FOMC minutes news of recession does not change anything about the chart. We still have the same risk levels, and we still have to take on the same amount of risk as we were before the news dropped. On the Nasdaq 100 triple Qs, we were down 0.88% today, and the triple Qs came right back down to the rising 20 daily moving average, which is also going to be a retest of the daily breakout zone right around 312. I've drawn this retest before, and now we are currently in the situation where price action is coming back down to this retest on the daily chart. And from here, this is going to be a great risk reward setup with the bull trend to buy the dip off of a very well-defined support level before we possibly go fill the gap at 322 or hit the double price target at 327. If you're so scared of the possibility of a recession later this year that you totally overlook the fact that we're in a bull trend in the big tech sector that is the triple Qs, and you have a great risk reward setup right here, you could totally miss the boat on a very impulsive bounce if we start to bounce from this support. If we break support, then you're looking for the gap fill down below at 308 and this risk zone just below 307. Again, all of these are extremely well-defined risk levels, so you know exactly how much risk you're taking on if you're buying at these levels, and you can manage your risk based on what the price action does at support. If you're shorting at support, you're going to have a very tough time in this market, and we are currently at very strong support in the triple Q, so there's just no reason trying to short at support. Wait until support breaks down, and then you can short to lower prices. On the Dow Jones, we were down 0.09% today as the Dow Jones continues to push higher above all of the moving averages as it continues to strengthen that bull trend the longer it closes above this breakout just below 335. So you have very well-defined risk in the Dow Jones between 333 and 335, and if we break down below that, we're going for the gap fill at 329. The next upside price targets will be around 342 and 346, and we are developing a bull trend as we continue to climb higher. On the Russell 2000 IWM ETF, we were down 0.73% today after we did get rejected from that upper Bollinger Band just below the negatively sloping 50 EMA, and we do have a bearish engulfing candle that did close the gap below at 175. So without a doubt, this is a very bearish daily candle, but we are still above what could be support at 173, and we need to break down below 173 to go down to fill the gap at 172 and test critical support at 170. If we break 170, we are very likely going all the way down to about 164. So that is a very well-defined risk level if we start breaking down below the 20 daily moving average at 174. To the upside, if we do start to bounce, we need to break this high at 178.5, and then we'll be looking for critical resistance right around 181.4. On the ARKK ETF, we were down 2.89% with a very sharp rejection from the 200 daily moving average of resistance just below $40, and we're back down below all the moving averages on a very impulsive sell-off and very bearish engulfing candle, but we are still above the support zone at 37. If we break down below the neckline at 37, we have a double top, and if we break the neckline at 36, we have a triple top that could take us down to fill the gap below 32. We're not getting bullish until we get the break of this resistance at 40.5. On the VIX, we were down 0.16% today, and the VIX did reject from 20 yet again, so this continues to show there's just simply not a lot of fear in this market. If the fear of recession was running rampant, the VIX would be spiking well above 20 and into the mid-20s by now, and we just don't currently see that. So wait for the VIX to show confirmation that fear is hitting the market, and that's going to be that breakout above 20. On Bitcoin, we're currently down 0.85%, and Bitcoin is just getting way too far outside the upper Bollinger Band and due for a pullback, and the most likely zone for the pullback will be that price target at 29,400. You're bullish as long as you're above the breakout at 28,000, and if we break down below support down here at 27,000, then you can instantly get more bearish because we're likely coming down towards 25,000. On Google stock, we were down 0.67% today as Google is coming back down towards the rising 20 daily moving average, so there is going to be support right around 103 to 104. Below that, we have stronger support down here right around 100, and if we break all of that support, then we're instantly getting more bearish for a retest of the breakout at 95. I still think there's a good chance Google is climbing higher into earnings to go fill that gap at 110 and possibly even the top of the channel at 115. On Amazon stock, we were down 2.09% today as Amazon did get price action back down below all the moving averages, and we closed right on top of this very critical support zone right around 98. If we continue to break down below 98, we're likely coming down to 94 and then 90, and below 90, we do have a gap to fill at 86.4. We do have earnings coming up around the corner, so if we do bounce from 98, it's possible we do get an earnings run up that could take us to the gap fill at 109. On Microsoft stock, we were up 0.23% today, and Microsoft continues to get very close to closing the gap at 281, which is just above the rising 20 daily moving average, but so far that gap has not yet filled. That's a great risk level if you're looking to buy the dip because we do have a bull trend, and if we break down below 280, we're looking for the gap fill at 276. The upside resistance to break is 290, and then we can march higher towards the gap fill at 296. On Nvidia stock, we were down 2.48% today, and we did finally lose support at 267 and close below the 20 daily moving average, which means we're likely coming down to 258. If at any point we break back above 267, you still need to be bullish because we are still in a bull trend if we can quickly reclaim that support. If we get rejected from 267 and break support at 258, look for the next downside target down here at 242. On Tesla stock, we were down 3.35% today with a very bearish candle and a sharp rejection from that resistance at 190, which is our 20 daily moving average, and we did close down below critical support at 183, which increases the probability we're going to 173 and then 167. Remember, any rejection from here and a confirmation of a downtrend could take us all the way down to fill the gap at 146. Do not get bullish until we can at least start closing back over the 20 daily moving average, which is currently at 190. On Apple stock, we were down 0.44% today, and Apple is closing right on top of some critical support at the rising 20 daily moving average at 160. Below that, we retest the support trend line and close the gap at 158. So we have very critical support, only $2 apart. And if we break the support zone, then we're looking for a retest of 156, which is the neckline breakout. All of these levels are viable support if you are bullish on Apple, and if we start bouncing from any of this support, we simply need to break the resistance up here at 163, and then we'll likely start marching higher towards 169 and the gap fill at 171. On the financials, we were down 0.22%, getting rejected from the upper Bollinger Band, but still bullish as long as we're trading above 32. The industrials were up 0.33% today, reclaiming the 50 EMA as support, and the longer we can hold above this level, the more likely we could build a bull trend. The healthcare sector was up 0.03% today, still struggling to break that resistance at 134, but still bullish as long as we're above 130. The energy sector was up 0.07% today, continuing to build the bull trend. As you can tell, all these moving averages are now positively sloping, so stay bullish as long as we're above the breakout at 84. So jumping back over to the S&P 500, without a doubt, this is a very bearish looking daily candle and a sharp rejection from critical resistance at 411, so you need to respect that. The next breakdown for the bears is going to be a loss of support, so wait for the confirmation in the price action, and do not get bearish while we are at support. Wait for support to break down, and then you could use that support as a newfound resistance level and set your risk accordingly. Get in the habit of being a disciplined trader and managing your risk, and you are going to do very well in this market. If you start getting emotional or you have a bias that you can't kick, you are going to have very difficult time trading in this market, because if you're letting a bias stop you from following the chart, you are going to start making emotional decisions, and that's where you're going to start losing your money. If you want to come trade with other price action traders and get access to all of my intraday updates and analysis, come join us over at the Stocks Channel Trading Discord community. I also have bank trade alerts, which will send you all of your buy and sell alerts directly via email and text message, and only trades ETFs TQQQ and SQQQ. You can find out how to join the Stocks Channel Discord or bank trade alerts by clicking on the links in the description of this video. So thank you for watching, everybody. I hope you're crushing this market, and as always, I will see you in the next episode.